All right, guys, we got a huge guest on the podcast today. Since 1999, he's been doing real estate deals over $1 billion. That's right, $1 billion in real estate deals. And every single year, he does about $40 million in notes. And if you don't know about owner financing or note investing today, you're going to learn a lot about this. My guest, David Campbell, is on the podcast. Hard to wrangle him down. We got him on here, guys. He's going to give some important information. Talk about what a note is, maybe first and second notes, kind of the note process, how to sell notes to David himself. I actually have sold notes to David over the years. And then we're going to be talking about what he sees in the industry happening right now. Is this a threat? Is it an opportunity? And it's going to be a great podcast. So David, welcome to call. Looking forward to hearing what you have to say today.
Hey, I'm so excited to be here, and it's so exciting to see you face to face and talk with your listeners.
Yeah. So, I mean, you've been killing it for years, and you've been always great to work with. You've always done everything you said you're going to do. You always get the money to the title company. When you said you're going to do it, you've given me great prices on the notes that we sold to you over the years. But maybe let's start basic for investors on my channel. Right now, creative financing is going to pick up all across the country. The traditional deals, wholesaling, flipping, normal rental properties, obviously, creative financing strategies can be starting to pick up in relationship to what they normally do, is what a lot of people are telling me. But what is owner financing? What is note investing in the way that you see it? And maybe kind of break it down for a brand new wholesaler flipper that may want to start doing what you're doing, or that they can start understanding how to do this strategy so that maybe you can start creating notes so that you can buy them going forward.
Fantastic. So let me break that down slow. So a note is very simply a promise to pay. So there's a borrower and a lender, and the borrower agrees to pay the lender a certain amount of money over a certain amount of time. And the thing that makes real estate notes really attractive is if the borrower doesn't pay on that note, there's collateral, which is the real estate and the equity in the real estate that makes that note a solid investment. So in some states, that note is secured by a deed of trust. In some states, that's secured by a mortgage. But anecdotally, people call them mortgages, regardless if they're notes and deeds of trust. Notes and mortgages can be bought and sold freely. So if you've ever borrowed money from a bank, you've probably worked with a loan originator who you did all your paperwork. And then a month or two later, you get a notice in the mail that says, hey, your mortgage has been sold to another servicer or another investor. Most mortgage notes that are created in the country are not held for their full term by the person who created the note. They're usually sold multiple times throughout the life of that note. So an opportunity for people who are doing seller financing is if you've got a hard to sell property, or you want to sell a property faster, or you want to work with a borrower who really wants to buy your property and will pay a premium price for it, but they don't qualify for financing. A great strategy is to be the bank as the seller. So you're both the seller and the bank for that particular buyer. A great advantage for the seller financing, oftentimes if you get in the business of seller financing, there's very few people competing in that space. There's a lot of sellers that are willing to take cash, but there's very few sellers that are willing to finance a buyer. So if you've got a property to sell and you offer seller financing, you should be able to sell that property faster, maybe for a top dollar, or maybe with fewer repairs, or some type of concession that comes out ahead for you as the seller. Many property sellers want to keep their notes for income, and some want to sell that income stream for a lump sum of cash. Many people who are considering seller financing as a seller, one of their biggest obstacles is they say, well, I owe money on my loan. Like, I borrowed money and I have a bank that I have to pay off, so that I can't sell my home on seller financing. And that's actually not true. Your bank doesn't want you to do that seller financing. They don't want you to resell your home without paying them off, but you can. It's not against the law. It's just usually a breach in the due on sale clause of your mortgage. The vast majority of lenders don't know, or realistically, practically don't care if you sell your home on without paying them off, which would be a violation of your due on sale clause. Some states prohibit the recording of new financing without paying off the prior financing or permission of the existing lender. But Texas, which is the state I do most of my business in, is very lender friendly, and it's a great opportunity to sell a property. If you have a low interest rate loan to your bank, and then you sell your property on a high interest rate, there's an opportunity to make a spread there. I call that arbitrage, or positive arbitrage, when your sale rate is higher than your borrowing rate. That positive arbitrage is a secondary profit center. So if you owe Bank of America, for example, 5% on your loan as a borrower, and you can sell that property on 10% interest rate to a buyer, now you're making a 5% positive arbitrage spread on other people's money, it's great. So when you look at that yield on your equity, sometimes the yield on your equity can be double digits because you're using the bank's money to get that spread. Now, what happens when you either want to lump sum of money, or in the 1% to 2% of times where you do a seller finance transaction, wrapping the underlying lien, and your bank says, no, I don't like that. Your note is now accelerated. You must pay your full loan now as the borrower seller. That's when people call me and they say, hey, I've got a wrap note that I need to unwrap. Can you buy this note, pay off the existing bank note, and then everybody's happy? The borrower bought the home is happy. The seller, who was also a borrower, is happy. I'm the buyer. I'm happy. The bank who loaned the money, they're happy. So that's a good strategy. Sometimes, though, as a word of caution, when people are creating notes, when they're thinking they're going to hold the note forever, they write really crappy paper, right? Either their documentation or their deal structure or something about it is crappy. And they're like, I don't care because I'm going to keep this note forever. But lo and behold, something changes. Either their underlying lien gets called due, maybe there's a death or a divorce or a cash call or a pandemic that causes someone to need a lump sum of cash. And they say, hey, I was going to keep this note forever and now I'm going to sell it. How much will you pay me for it? And I look at the deal and I say, well, if you had called me from the beginning, I could have counseled you on how to create a deal structure to get top dollar for this note. But here's 3 critical flaws that are in your note that unfortunately I'm going to have to discount the heck out of your note, where we could have avoided this if you just talked to me before you closed your.
Well, let's dig in. We'll talk about what you want to see as a note, how it's structured to make it something that you want to buy, and what's the right way to structure it. But I want to kind of ask, what makes a David Campbell? Did you come up through the rental business? I know it's a very common question. If so, do you still own rental properties? Do you do both rentals and notes? And why would someone want to do owner financing and carry notes and not be a landlord and own rental property?
Yeah, fantastic question. So a little bit about my background. I started out being a high school bands teacher, and I started buying rental property just as an investment, and it did great. And after about 5 years of being a real estate investor, I was making more money doing real estate than I was teaching high school band. So I quit teaching high school band and became a full-time real estate investor, developer, and broker. And about 2005, I started a real estate development company and got into condo conversion, land development. About 2008, when the economy crashed, a lot of my California investments were terrible, upside down, losing investments. Where can I go that's safe? And so I started looking across the country of what market I thought would be significantly more resilient in a recession. And I picked Dallas-Fort Worth, Texas. Turned out that was a pretty good bet to go to Dallas-Fort Worth in 2008. We did pretty well. I started a home building company in 2008 when everybody was selling land real cheap, and the home, all the construction trades were happy to work just for gas money and very grateful to have a job. I grew that company to one of the largest builders of entry-level homes in the metro. And that a lot of the homes that we sold were to Hispanic buyers that had great income, and they had a down payment, but they didn't have credit, or they didn't have a social security number. And so it kind of like a bell went off, like, this is a really well qualified buyer, but because they have an ITIN number, not a social security number, they can't get a loan from a bank. Or maybe they have no credit at all. Maybe they do have a social security number, but they've never taken out a loan for a car or a credit card or anything, just no credit. So they couldn't buy the houses that I was selling. So I thought, let me become the bank and start selling the houses that I was building. And that was a great strategy to get into the note business. And then I also started financing other home builders. Home builders saw that I was building houses when no one else was building houses. And they said, how do you finance these? And well, private money. And I was able to get my money direct from investors at the time rather than going through another hard money loan broker. So then I started brokering single family construction loans to other home building companies. And then that grew to be a commercial lending. And then the notes that I was creating as a home builder, because I was creating a lot of notes, I didn't have the capacity to keep them all myself. Like I didn't have the cash to just be the bank on every one of these. And because I was building them with private money, hard money, and then I was selling them on hard money rates, there was no positive arbitrage there. So the best solution for me was to resell those notes to investors that wanted income, that didn't want the hassle or risk of being a landlord.
Yep.
Most of my note buyers then and now are IRA investors, people that have a self-directed IRA. They want to get income. They want to get 9 to 10% rate of return on their money. They don't want the hassle of landlord, or they're just looking to diversify. Maybe they're a real estate investor in their taxable account, in their personal tax capacity, but they want something for their IRA that's very IRA friendly. Yep. It's very difficult to borrow money in your IRA to get the kind of leverage that's good for real estate investors. And it's very tax unfriendly to own long-term rental real estate in your IRA compared to owning that rental real estate outside of your IRA. And mortgage notes are very kind of tax unfriendly vehicles. They are taxed as interest income, which is ordinary income rates for if you hold it outside of your IRA. But if it's inside your IRA, then that very tax efficient bucket of a self-directed IRA makes the mortgage note, I think, a very perfect, very suitable investment for self-directed IRA. Yep. Also, I sell mortgage note fractions, which means I could take a $100,000 mortgage note, break it into 4 pieces or smaller, and maybe for 25 grand, you can have 25% tenants and common interest in a mortgage note. So if you have an IRA, even a relatively small balance self-directed IRA, you can get into mortgage notes where it would be harder to get into direct ownership of real estate. Good.
No, it's incredible. Just people are probably sitting here like, whoa, this guy, look at what he's saying here. So this is new to a lot of investors, right? So let's take it from the perspective of newer investors or even individuals right now, because I don't know about your take. We'll talk about this in a second, but I see this as a perfect storm. A lot of individuals, like you said, create these notes to hold long term. They're going to get in a pinch here. They're going to have to dump out. What is the best way to structure a note? What price points are you looking for? What interest rates are you looking for? What's the down payment that you're looking for on the front side? What makes a note attractive to someone like you or any of the other individuals that are buying notes? And kind of give your idea on this so that they don't make a mistake to get a lower price point when you offer on it. And then what are you willing to offer if they do structure it so they can have an idea so when they can start playing with numbers before they reach out to you?
Awesome. Those are great questions. So the primary common sense thing I'm looking for in a note is, am I profitable if I'm repaid? Am I profitable if I'm not repaid? Because those are the two outcomes when you make a note. In my experience, about 80% of our owner finance buyers, the consumer type borrowers, about 80% of our borrowers pay on time. About 15% are paying just a little bit late, and about 5% of the time we have to foreclose. And only about 2% of our portfolio actually becomes REO, a bank-owned asset. Sometimes we lose money on our REO, but usually not. Usually foreclosing on the asset is a profitable outcome for our company. So when I'm looking at a note, I'm primarily asking myself, do I want to own this real estate for the amount of my investment in the deal? I don't want to buy the property for retail. I want to buy the property for ideally 75 cents on the dollar or less as the note investor. So when I look at a deal and somebody says, hey, I've got a $100,000 property that I sold and I created a $75,000 note against that property, and there's 25% equity in the property, that's a very strong risk position, or very low risk position for me as a lender. And so I check that box that my risk is good. If the risk or the LTV is higher, I'll still buy the note. I'll buy a 100% LTV note. I'm just going to discount my purchase price for that note to make my risk lower, right? So I might not pay, let's say it was a $100,000 property, and pretty typical in the Texas market is people are putting about 10% down. So a $100,000 property, you create a $90,000 note. I'm not going to pay 90 cents for that 90. I'm not going to pay $90,000 for that $90,000 note. I'm going to discount it for risk. The other thing I'm looking for is yield, because I know right now when I buy a note and then I go to resell it, I'm trying to create an annualized yield of at least 10%, and ideally closer to about 11% annualized. So if somebody creates a 30-year note at 3% interest rate fixed, oh my goodness, I have to discount that note a gigantic amount because they've locked in that yield for 30 years at 3%. And so for me to get my 10 to 11% annualized yield, the note seller has to take a huge hit on their principal, on the unpaid balance. So it's really important that people are writing to get top dollar, at least from me, that the interest rate on that note is ideally 9.5% or higher. It doesn't have to be 18%. I mean, I'm not really shooting for those high yields, but if it's not at least 9.5%, expect to get a discount. At least I'm going to discount the note for yield purposes. The other thing I'm looking at is cost of servicing. Right now, in 2020, I forecast a little bit of a deflationary economy followed by significant inflation. And so if you are writing a note, let's say it's a $100,000 note at 10% interest, let's say. If you're doing a 30-year note, which is a pretty common thing in the seller finance business to get that payment low by doing a 30-year fixed note, the cost of servicing doesn't seem like a big deal right now. Like professional servicing is about $35 a month is the servicer I use. That's about what they charge. And so today, $35 a month compared to $10,000 a year of interest income on the note, it's a cost of doing business. It's not that big of a deal. But if we have a hyperinflationary event and gasoline is $100 a gallon and hamburgers are $200 a piece, the cost of servicing is going to be 100% or more of your interest. And so no borrower is going to pay off your loan if there's been a hyperinflationary event and their payment is, peanuts, right? They're probably just going to keep that loan in play, which means your yield is, as a note investor, is going to be decimated just on cost of servicing alone. And you can think back and say, well, what did things cost 30 years ago, right? Because if you're going to hold this note for 30 years, that last year of that note is almost all principal. Like there's hardly any interest in that last year of payment. And so it's very possible that the cost of servicing could exceed all of the interest for those last 2 or 3 years of the note. So you might have 3 years of negative yield on that note because of cost of servicing. So something that's really important to me when I create a note is the borrowers pay principal, interest, taxes, insurance, and I bake into the note that they also pay the cost of servicing as it increases over time. And so by adding that cost of servicing as a borrower expense, not a lender expense, that insulates me quite a bit from inflation.
So you're doing 40 million in notes a year is pretty typical for you. So let's talk about the entrance and the exit of these deals. Are you staying in the deal for cash flow? Are you selling some and getting out of them? Are you holding partials? How do you acquire the capital to get in this? This is one of the big frustrations that I see a lot of investors trying to figure out is how do they get the long-term money? They can all get short-term money for house flips, quick in and out deals for hard money lenders or private money lenders. But what about the longer-term money? Where are you going? Did you build a fund? You're just doing all private money, all IRA money? Is it a combination of different things? And how do you hold these notes long-term with that type of volume, I guess you could say? And then what's your main exit strategy and kind of give an idea of you stand in your shoes?
Yeah. So for me, or for every investor, you're going to run out of money. It doesn't matter whether you start with $40 million or $40. Like you're going to run out of money real fast. So to be successful in the note business, you can never run out of money. Because if Connor calls me and says, hey, I've got a deal, and I say, well, it's a good deal, but I don't have any money, you're going to build a relationship with someone else that has the money, right?
Right.
So I always have to have money. So what I do is I create the notes, I buy the notes, I use my own money to do that. I'm in a very fortunate position to have the capital to do that. I created that capital primarily through investing and home building and things like that. But I would run out of money if I didn't resell the paper. So for example, maybe there's a $100,000 property, a $90,000 note, and maybe I'll buy that $90,000 note for $75. Let's just use that as an example. I'll take that $90,000 note and I'll divide it into a senior interest of $75,000 and a junior interest in that note, or a subordinate interest in the note, for $15. So then I'll buy the note for $75,000 bucks. I'll resell a $75,000 interest in that $90,000 note. I'll resell it for $75,000. So now I have all my capital back, and now I have a 15% LTV subordinate interest in that deal. But I now have zero basis. I have none of my own money into the deal. That's a really attractive model, because for the senior investor in that deal, they're at 75% LTV. So if the deal goes sideways, their equity position or their risk position is very attractive at 75%. For me, being a junior lien holder behind a 75% LTV note, that's very, very risky, but I have no basis or minimal basis in that junior lien. And I know statistically that 98% of my notes, based on my underwriting criteria in the markets that I pick, about 98% of my notes historically have paid as agreed. And so maybe 1 or 2 out of 100 are going to result in a total loss, but 98% I'm going to get my money out of the deal. For that senior lender, it's also very attractive, because now me as the junior lien holder or subordinate lien holder, they know there's another interested party to make the deal a success. So if the borrower doesn't pay, then me as the junior lien holder, I've got to make that senior lien holder whole, or I lose my junior lien investment. And so what I tell my clients is, I can't guarantee that you're not going to make money or lose money. I can't guarantee that. But if you lose even a penny of your investment, because I lost 100% of my investment in the deal. So I'm going to take a 100% loss before you take a penny of loss. And also, we've got in-house legal counsel that chases the foreclosures. And that's a great economy of scale for one-off investors. So most of my clients, they start with 1, 2 notes, and they build a note portfolio from there. But we've got hundreds and hundreds of junior lien notes that we monitor with the servicing company. And when the servicing company gives us a delinquency report each month, then our in-house legal counsel is chasing down those borrowers in foreclosure as the junior lien holder. And so the senior lien holder doesn't have to do, in the model that I've created, the senior lien holder doesn't have to do a whole lot, because I'm doing foreclosure as a junior lien holder. I'll get possession of the property. I'll do the eviction as needed. I'll get a contractor in there to do a make-ready estimate. I'll do a CMA on the property. And at that point, basically, as the junior lien holder, I have an option to say, this is a great flip. I just bought, quote unquote, bought this property for 75 cents on the dollar as the junior lien holder. Or, you know what, this got beat up inside. My CMA was off. Maybe I didn't underwrite this correctly from the beginning. Maybe I'm upside down. Then I can just deed the property to the senior lien holder, and they say, hey, no harm, no foul. Like, I didn't have to spend money or hassle in doing the foreclosure. I didn't have money and hassle in eviction, or now I've got, a contractor and photos and a broker to go do the flip for me. And my senior lien holders are happy. They're like, hey, I didn't get my interest, but now I've got the property in a hassle-free way. And then another, because I've got economy of scale, very often those senior lien holders want to be fairly passive in the deal. And so very often they'll hire my team to do the rehab and the broker on the exit of the deal. So even if I wind up losing all my investment as the junior lien holder, I'll get a little bit of money on the backside by just being a service provider to that senior lien holder in the deal. So that's a good for you to have infinite returns, right? Use your own money, fund it, resell a senior interest at par pricing or at a premium, right? Not premium like over par, but just like at a high, buy it at a big discount, resell a premium or low risk position at a lesser discount, and then you keep the spread on the back end.
It's incredible leverage. So now the cool thing that you're doing this remotely. So are you doing this in all 50 states, certain states you're looking for primarily? And then talk about your pre-qualification, what it is that you look at. Are you vetting the individual buyer on the front side? Are you looking at their credit scores? Are you really just looking at the numbers on the note and the yield? And then what type of conditions of property are you looking to buy? Are you going to look at this as far as could have a lot of repairs costs long-term to it or not? How does that kind of look from your side?
Mm-hmm. Yeah. So just putting my common sense hat on, I primarily am saying, would I be happy to get the phone call that the borrower didn't pay? Because if you get the call that the borrower is not paying and that's a bad thing, then you didn't underwrite your deal correctly. So in that context, every borrower is kind of irrelevant to the deal, like their credit score, their job, whatever. A lot of my clients are looking at that information because other people look at it. It's interesting to me, but I really don't care what their credit score is. Their income, I care about only from the standpoint that I don't want to be in the business of doing predatory loans, both from a compliance perspective and an ethics perspective. I want to believe that the borrower, that their historical income, there's a reasonable chance that they can make the payment. I don't care what that income documentation is. It could be bank statements. It could be a letter on the back of a napkin. It could be just their own statement. I've had borrowers take pictures of themselves holding a wad of cash and just say, like, I earned this money at the swap meet. Like, I really don't care what their documentation is, but they're going to tell me of their own volition that they can afford the payment. And if they lied, then they lied. Like, I check that box. At least ethically and compliance, that they told me they could afford the payment. And the affordability is I'm looking for about 46% debt to income ratio or lower from the borrowers. Credit, I don't really care what their credit score is. If I do see like credit abuse, then I don't like the deal. For example, if they have medical bills unpaid, I don't care about that. If they've got like slow pay on their credit cards and things like that, I don't care. But if they owe landlords a bunch of money and I see a pattern time after time after time where they leave their real estate person owing, I just will walk. I just won't do that.
How do you look at the down payment? So you going to give a higher offer? Someone's took, let's say, $5,000 down, $100K house versus $10,000 down versus $20,000 down. How does this affect how you see it? And I guess that's a big part of how you see the borrower as well. And it minimizes your risk a little bit.
Yeah. So I'm primarily interested in loan to value. So sometimes the people that create a lot of paper for me, and we do a lot of recurring business, they also want to keep the tail end of the note. So they'll say, hey, I'm going to get no money down from this borrower. And they'll create maybe a 20% LTV second lien and an 80% LTV first lien. And they'll sell that 80% LTV first lien to me, and they'll keep that 20% LTV second lien. I don't care whether it came from the borrower or from the seller. As long as the equity is there for my risk position, then I'm happy. It could be that someone says, hey, $100,000 property, borrower did no money down. What do you pay for this note? Well, $100,000 note on a $100,000 property, assuming I like everything else about the note, maybe I'll buy that for 75 cents on the dollar or 75 grand, right? My risk is the same, right? And I've got that 25% equity cushion, but I didn't get it from the borrower. I got it from the property seller. So for property sellers who want to get the most money for their notes, the bigger the down payment, the better, up to about 25% LTV. If the borrower puts 25% down or 30% down, I'm pretty much paying the same for the paper.
So we're coming into what I think we're going to see probably next year, a big foreclosure push once the stimulus money stops getting pumped in the marketplace and all these forbearances kind of go the wayside. So a lot of people are going to be doing sub-2 deals because they're going to have no opportunity to really do anything with property. A lot of people bought houses in 2017, 2018, 2019 with no equity in them. So how would that work if someone takes property to sub-2, and what would you advise them to do to best work with you? Do you want them to go ahead and sell it, or do you want them just to contact you right away? And what does it look like when you're buying wrapped mortgages? How does that kind of look when you look at these deals?
Yeah, so I love sub-2 deals. And so if there is, for example, $100,000 property and they've got a $100,000 loan to Wells Fargo and they want to sell it and there's no equity in the deal, then I'm probably paying very little for that note, right? Because what I'm doing is buying the equity in the note, right? So if they had a $100,000 property with a $100,000 note, and they were able to resell it for, and I didn't explain that well. Let's say there was a $100,000 sales price, and they owe Wells Fargo 95 grand, and they were able to sell it on a $100,000 note. Well, there's $5,000 of equity there. That really isn't enough equity for me to pay anything for that note. So because of risk, right? I need to be a 75% LTV position. So I would say if someone has an opportunity to buy a deal sub 2 and resell it on seller financing, then what they're really doing is a cash flow play for themselves. Like there's no equity lift that they can gain by reselling it because there's no equity in the deal. Just buy it sub 2, pay Wells Fargo, their 5%, resell it at 10% or better, and then make that spread, and then just hold it. There's really nothing to sell. But sometimes people do sub 2 deals with equity, but it's pretty rare.
Now, what about this? So I have a pretty good feeling a lot of investors are going to get caught with their pants down with this. They're flipping houses on hard money loans, private money loans, on in and out deals. Is there any solution you have for them when they borrow an interest-only loan from a hard money lender to flip a house that's almost finished or partially finished? Because I have a feeling a lot of investors were getting away with depreciation, the market going up for so long. They're going to have 6, 8, 10 flips going. They can't finish them. They may have equity in the property, but it's not an amortizing loan. Is there any solution for them that you have for them to work with you, or is they pretty much fin to the wolves?
It's going to be a hard place for them if they have minimal equity. I think one of the best solutions would be if they can resell it to the marketplace on seller financing. They're probably more likely to get a buyer faster at a premium price. And then once they have their property sold to a consumer, then I can buy that note and pay off their underlying lien.
Okay.
So when you can wrap an existing lien at positive arbitrage of at least 2%, I recommend doing it. But if someone's got a hard money loan of 10% or higher, and then they resell it to consumer at say 9.5%, that's negative arbitrage. You don't want to be in that position. So they would sell me a 9.5% note, and then hopefully my purchase price for that note is enough to pay off their hard money lender.
Okay.
And then there's more wrap.
Yeah. Before we dig into the last part, I want to talk about just the type of properties you're going to look at. Are you going to do you just do single family? Will you do commercial properties? Will you do lots, land deals, anything like that you want to stay away from or that you like doing that maybe you can bring up right now if they have these types of properties they can send to you?
Mm-hmm. Yeah. So I love deed of trust states, not mortgage states. So if something is judicial foreclosure, meaning you have to go to court to foreclose, I don't want to do business in that state. Many states have a licensing requirement for originating notes, but they don't have a licensing requirement for buying a note, right? So maybe someone in a deed of trust state says, hey, can you loan me money to buy this house? Probably not, right? Because there might be a licensing requirement that's state specific. But if they said, hey, I seller financed the deal and I'm exempt from licensing because of seller financing, because you get a certain number of, usually depending on the state, you get a certain number of sales that you can do per year, exempt from seller financing to consumers. Then if they created the note, they could sell the note to me, and that's fine. Like I don't need a license to buy an existing note. Then in terms of like property type, I really prefer entry-level single-family home where the cost to rent is the same or not significantly lower than the cost to own with that private loan, right? For example, many of the deals I'm doing in the Dallas-Fort Worth Metro, maybe it's $1,400 a month to rent that property, and their 90% LTV loan, even at 9.5% plus cost of servicing, principal, interest, taxes, and insurance, it might only be $50 more than the cost to rent. That's a good deal for me because if I get it back, I can put a tenant in the property and get an equivalent income stream And also, it's more likely that that property is going to preserve value because purchase prices fluctuate a lot faster than rents do. And so, if I know that, investors typically in Texas will buy something at 100 times monthly rent. So if I'm getting $1,450 in a note income and it rents for $1,400 a month, good chance that I can resell that property for 140 grand or more. So I'm going to look at that in terms of my risk exposure. Like, I don't want to be invested more than about 75% of the 140. As the purchase prices go up, that formula breaks down, right? So sometimes maybe someone wants to do a $500,000 seller finance note at 10%, and their payment could be 2 to 3 times what the monthly rent is. And that's a big red flag for me. I don't want to do that.
Okay. What about listed properties? So I don't know. I know you know a little bit about me, but I'm also an agent. I run a real estate team, about 400 agents, and so I know they're going to want to know, a lot of individuals, investors sold a house on auto financing. That borrower's getting in trouble. They're going to find a real estate agent to put it on the MLS. How does that work if there's an agent involved in the middle? You're paying their commission, they're paying the commission. There's like, what would that look like? And is that even something that you'd be open to doing? Because I feel that there's going to be a lot of inventory flooding onto the market here soon in that situation.
Yeah, so I would recommend, if you're a real estate agent or a property seller and you get a buyer that is interested in purchasing seller financing, to call me and say, hey, I've got a willing buyer and a willing seller that want to do a seller finance transaction. Could you give me 3 minutes of your time to figure out the best way to structure this note if the seller wants to resell the note? Because many sellers are resistant, many retail consumer sellers are resistant to being a seller finance lender because they think they're going to have to be a debt collector for 30 years, and that's just not the case. So your agent can educate their seller, hey, if you, and I offer this advice to all my investors, when you sell a property, always offer seller financing. Like, just check the box in the MLS, like, I'm selling for cash and I'm selling for seller financing, because there are a certain number of buyers that are doing an MLS search only for seller finance properties. And there's very few properties that are going to come up for seller financing, depending on your metro. Like, Dallas has got a lot more than maybe San Francisco, as an example. But when you come up with a seller finance transaction, you can create it in such a way where your seller is going to get all cash. Like, the property seller will get all cash, even though it was a seller finance deal, because you sell the note to someone like me.
Now, what happens if everything hits the fan, right? So let's say you've taken on all these notes. Some people are not going to pay. What happens when you have to go through the foreclosure process? Maybe walk us through this, the timing of this. What's the first step these individuals do? Because I know this is going to be a lot of them asking, well, yeah, well, that's great. Once I have it, what happens if I'm in Florida and they're in Texas and they stop paying in Texas? What would be the step-by-step process on how you handle this?
Yeah. So if someone's buying a note from me, it would be different than if doing it on their own, right? So if you're doing it on your own, you would find an attorney to do the foreclosure. Then you find someone to do the like a knock on the door to see if someone's living there. And if they are not living there, then you rekey, get a contractor to fix it up, hire an agent, you sell it, right? If someone is living there, then you just the added step of eviction on the process. My preference is loan workout. So if a borrower has a positive payment history with me, but then something happened like COVID and they can't earn for a certain period of time, then I'm very motivated to work with them because the cost of foreclosure, it can be high depending on the state. Like in Texas, I'm averaging about $1,200 to $1,500 for a foreclosure and eviction. In some states, it could be as much as $5,000 to do a foreclosure eviction. Texas is pretty fast. If borrowers miss 3 payments, I can usually get them out and then evict the following month. So from the time they miss their first payment, usually I can have the keys to the property in about 5 months, 6 months if I'm just slow in pulling the trigger to foreclose. But some states, it could be a year or longer, which is why I really like Texas. I mean, I live on a ranch in Oregon, but the vast majority of my business is Dallas, Fort Worth, Houston, Austin, San Antonio. So I will work in other markets, particularly if there's a borrower relationship. Like I've got some client relationships in Florida, and I don't really like doing business in Florida, but I really like the people that I'm working with in Florida, and so I'll go to that state just because of the provider, the people who are providing the inventory for me. I really like. But so to how do you solve a non-paying borrower situation? Particularly in a declining price environment where there's lots of inventory, you want to work with your borrower. So you can take the extra payments, add them to the end of the loan, take the payments, spread them out over a period of time, whatever you can work out with that borrower so that they make partial payments. That's my preference. But if somebody can't pay anything at all, I usually want them out. If they can make a slow pay, I don't mind slow paying borrowers, but no pay borrowers have to go.
Okay. What's the biggest pitfalls you see, like that you deal with all the time, that new investors doing this won't expect to know that they'll come across, as far as risks, like people filing bankruptcy, things that they can do to kind of mess with you, slow the process down? What are some of the things that you see as kind of the headache part of it, and how do you kind of get around those?
Yep. So lender title insurance is hugely important to me as a note buyer. And many people who are doing seller financing think, hey, I bought this property with a title insurance policy, and then I resold it without a lender title policy because I wanted to save a buck and save a couple days. And that's not a good idea, right? Because now when I buy that note, let's take a step back. When you resell a property, the buyer borrower pays for the title insurance, right? Even if you add that cost to the loan amount, the borrower buyer should be paying for that lender title insurance. Let's say you resold your property and you have a note that doesn't have a lender title policy with that note, and then you try to sell that note to me. The only person available to pay for that lender title policy is the note seller. So that note seller is going to take an extra haircut off that thing. The other thing is, at the beginning of the transaction, the borrower is there and they can provide all of their information for federal tax liens and things like that. And they've got a motivation to cooperate with the lender because they want to get ownership of the property. But after they're in and they've signed and they've got the keys and they have the deed, and then you want to add a lender title policy later, sometimes you have to go to that borrower and say, hey, I need your social security number and your driver's license. And they're like, I don't want to give that information to you. And then it's harder and more time consuming to get that lender title policy in play. The other thing is not collecting borrower information at the beginning of the loan. Like something simple like their driver's license, their tax ID number, and a credit report. Even though I don't care what that credit report says, I'm looking for judgments, like tax lien judgments, or like federal tax judgments, or judgments that would attach to the property because they followed the borrower into the property. So that's a reason why I want a credit report. The other thing that is a big problem for new note investors is they want to self-service their mortgage payments because they say, well, why the borrower doesn't want to pay $35 a month, or I want to make that $35 a month as a servicer. And then when they self-service, and then they go to resell, it's just, I want to trust but verify. Like, hey, I believe you've been self-servicing this, but can you verify to me all of the payments that this borrower has made? And usually the answer is no, right? And then, well, let's get an estoppel. Can you have the borrower sign this estoppel that they've not prepaid this note? Because that's a big risk, right? Someone could say, hey, there's $80,000 left on this note, and you buy it on that representation. And the borrower says, no. Remember that one time that I wrote you a $10,000 extra check, right? Where's that represented in my payment history? So that's a big mess, right? So having third-party professional licensed bonded insured note servicing, worth every penny. The other thing is that new investors screw up is the impound account. So if you are doing a consumer-based owner-occupied mortgage, I believe Dodd-Frank requires that there be a fully impounded payment. for those mortgages. So some people just don't collect the taxes, insurance, and that payment, or they decide to self-service and they collect their principal, interest, and then the taxes and insurance component. They just lump that money into their personal checking account as the lender, and that is not compliant, because that money, those taxes and insurance, are held in trust for the borrower. So you can't just mash all of that money into your personal checking account.
Yeah, so don't send him a shoebox full of napkins with your numbers written on it, right? Yeah, so we use August REI.
Yeah.
I'm sure yeah.
REI.com. They're fantastic. I have no vested interest in that company, but they do a great job. Very affordable. It'll make your notes worth more money if you have professional servicing.
Yeah, so I'll say that again because we're kind of talking over each other. So Amy Sayer with August REI, we both use her. She's a good friend of mine, so check her out. I guess last thing is, what do you see in the marketplace with this craziness that just happened? Has this impacted your business? Do you see this as a threat? Do you see this as an opportunity? What do you personally see coming forward? I know you talked a little bit about that in the beginning, but kind of give me your thought process going forward in the next 2, 3, 5 years. Do you think we're going into a correction, and just what's your take on it?
Yeah. So I think the correction has to do with the aggressiveness of the government stimulus response, that there's been so much new money printed in response to the crisis that isn't circulating. So the supply of currency has gone through the roof, but the velocity of that currency is really slow. So what we're seeing is deflation, or the price of things going down. Your currency buys more money. We're having deflation, even though the supply of currency went through the roof. And that's opposite. Usually when you have more currency, the price of things go up, inflation. But we're seeing deflation because people take that money and they're hoarding it, or they're paying off debt with it, right? It's not circulating in the economy. As soon as that money circulates in the economy again, I anticipate significant inflation. I don't know if it's going to be like double digit, but it's going to be much higher than the 2 to 3% that the Fed is targeting. I think we're going to have some pretty aggressive inflation. So as an investor, in the short term, I want more money in notes, because if I can buy a note, then I'm buying something where the income stream and the principal balance is getting stronger, right? As the price of gas goes down. Maybe that's not a good example because there's a gas war, but like the price of food, right? If the price of food goes down, then my note buys more food. The income from that note buys more food. As the price of everything goes up, then my income from the note buys less food, right? So the purchasing power of that note increases in deflation, and it decreases during periods of inflation. So for me as a note investor, short-term notes are a fantastic vehicle. And then long-term, I want to be a borrower of some capacity, right? So if I can borrow money and lend money and just make that arbitrage spread, then I've hedged inflation and deflation. Or maybe I need to own real estate as well. So I want to be a note investor. That's my primary thing. But I probably also need to own some rental property with borrowed funds whose cap rate exceeds the interest rate. And that formula where your cap rate exceeds your interest rate, borrow as much money as you can where your cap rate exceeds your interest rate. And that's a great inflation hedge.
What do you think with all this forbearance with these big lenders, people not having to make payments? How's that affecting things in your business?
So there's that forbearance doesn't apply to private lenders yet. I hope it never does, but it doesn't apply to private lenders. So there's a little bit of educational process of educating our borrowers that they don't qualify for forbearance unless we negotiate a forbearance with them. When the economy first shut down, I took a step back and we killed every deal in our portfolio, or in our pipeline rather. Like, we're not putting out money. I wanted to get collect. What was that? Probably March 1st. So our March collections were okay. They were better than expected, and our April collections were a little bit better than March, and now we've had May collections, and we're doing well, right? So I was expecting a massive drop in borrowers willing to pay and that just didn't materialize.
I've seen the same thing. I was expecting like nobody to pay. I was expecting transactions to drop, and it really hasn't as bad as I thought it was going to be. We'll see what happens next year and when things get crazy. But yeah, man, really, really grateful to have you on here. Glad we did. This is not brown nosing. It's one of the best podcasts we've done. I think you're going to help a lot of people really understand this process. And also, a lot of people exit their deals. So how do they work with you? Give them all your shameless plugs, how they contact you if they want to sell you notes and they get stuck in a situation, or they just want to go to, I know you give a free ebook out and you're helping and you got this back end process where potential investors can work with you with their IRAs. So how do they contact you? Where do they go? And we'll put the links below this podcast so go check it out.
Yeah. So my website is hasslefreecashflowinvesting.com. hasslefreecashflowinvesting.com. You can email me, David, at hasslefreecashflowinvesting.com. My phone is 707-373-9966. That's my personal cell phone. You can go to my website, and I've got 2 really awesome ebooks that are for free. One is called Secrets of Hassle-Free Cash Flow Investing, if you want to be a real estate owner. And the other is Secrets of Hassle-Free Cash Flow Lending, if you want to be a lender. I've got over 100 hours of free video training on my website. You can download great podcasts like this one that you can access. If you are a developer or a flipper and you need hard money and you live in a deed of trust state, a non-judicial foreclosure state, I'd love to talk with you about lending you money. If you are in the business of creating seller finance paper, like a flipper, where you buy homes, fix them up, and you resell them on seller financing, I'd love to be your sole buyer. I'd like to buy all the notes that you can create. If you're new to the space and you just want to figure out as an agent how you can get more business by working with seller finance buyers, there's some markets that are perfect for this, and other markets, high cost markets, where it doesn't work, right? So if you're in a lower price point market with primarily Hispanic borrowers, that's a great market because there's a lot of Hispanic borrowers that can't get financing because they're IT borrowers. That could be a great business relationship that we could have. But just check out my website. There's a lot of great free blogs. Call if I can help you put your note deal together.
Oh, looks like we're having an issue with Mike from there. Yeah, grateful to have you on here. I know we're going to probably want to get you back on here. It's a great podcast. And any last words that you want to leave here? Or we just let you go back to do what you're doing. It looks like you're having some fun out there on the porch. It looks incredible back there. I think a lot of people.
Yeah, it's this is Oregon. It looks like this every day. It is so beautiful.
I don't know what those are. Are those called trees? We don't really have those in Dallas.
Live where you want to live, and then invest where it's the opportunity to invest is. I mean, if you can create a great team of people, there's no reason that you need to look at a property. It is so weird that people are like, I must only invest within 15 minutes of my house. I'm like, I think you lose out on a lot of opportunities when you have that limitation. If you've got a good team that can give you good video, good pictures, people that you trust to walk the property and give you inspection reports, I can learn more about a property online than I can walking through the property. And so anyway, just really, I'm grateful to be on your podcast, and congratulations to your listeners who are smart enough to tune into your channel, because it's a great one.
Well, thank you. That's some really good advice. And guys, I appreciate you tuning in today, and we'll see you on the next one. Have a good day. Thank you, Dave, for coming on. We'll see you.